Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/The Smattering, to get access to the 10 best stocks to buy right now. My, oh my, has it been some kind of a bull run for oil stocks. The energy sector has absolutely crushed not just the S&P 500 as a total, but every other sector as a place for big gains over the past year and a half. One of the best places to invest right now, too, is looking at some of the oil majors, the big integrated international companies in the space. I'm Jason Hall. This is The Smattering. And I've got Tyler Crow here with me. Hey, Tyler, you're going to talk about kind of the secret super major and why you think it's really a compelling investment right now.
Yeah, obviously when people think of oil and gas stocks, sometimes we tend to gravitate to names we know, right? And when you think of names we know in this industry, there's a lot of retail stations that have ExxonMobil or Conoco or Chevron kind of smattered all over. Those being front of mind, those tend to be the ones that investors gravitate towards. But that's not necessarily always the best case, because I want to throw one out there that's similar in terms of business structure to ExxonMobil and Chevron that I think might be just as good, if not better, of an investment right now. And that's Total Energies. Total Energies is, like I said, an integrated oil and gas company, much like the other ones that we've mentioned, headquartered in France. So probably not the biggest name. You're certainly not going to see their stations across the United States. Living overseas, I've seen them much more frequently, especially Latin America, Africa, Asia, much larger presence in the retail business in places like that. But this is one of the things that really caught my eye when I was looking at them recently. We talked about higher prices just being good and that companies have become more competitive. They've slashed costs and things like that and become more profitable per barrel, even at more modest prices. And I think this is a great example of it. From 2008 to 2012 was more or less a period of higher oil prices that we've recently seen, right? Like above $100 a barrel, sometimes even
persistently for multiple years.
Right. And over that time, Total Energies averaged just under $30 billion cash flow from operations annually over that time. Over the past trailing 12 months, so this ending the third quarter, because we don't have fourth quarter numbers yet while we're recording this, relatively similar prices. They have some international price exposure versus domestic, so that they have a little bit higher price. Over the past year, trailing 12 months, their cash flow from operations has been in excess of $50 billion. Close to double what we saw over that 2008 to 2012 period. That is incredible. To be able to milk what you're getting out of it at that kind of rate is really indicative of the profitability of integrated oil and gas right now. They even say in their investing charts that their break even in 2014, the price to pay dividends, pay debt, and maintain their capital spending was $95 a barrel. Today, it's less than 25. And so it gives you a really good idea of how much more profitable they're likely going to be over the near-term future.
We take Total today, you think about where the business has evolved over the past decade. And we've done prior shows where we've talked about Chevron, ExxonMobil as well. I encourage people to subscribe to our channel, go back and find those. That's just getting better returns, getting better about how you operate your business, focusing on the assets out there in the field with the lowest cash cost to actually get the resource out of the ground and then get it through all the parts of the value chain you participate in. But I want to think about Total, not just how it's evolved over the past decade, but how has it set itself up to continue evolving as the way energy is generated and used around the world changes going forward?
So as their long-term goal, they're probably one of the more I would say slightly more ambitious in terms of shifting its focus versus like ExxonMobil, Chevron. Their big bet over the next 15 to 25 years is going to be LNG or liquefied natural gas. That's not uncommon for integratives. It's just been a more popular and profitable trade for these companies because
Well, essentially, the market share trade has been with the coal industry.
Natural gas taking coal as a power generating resource in Europe, in Asia, places where they're trying to, not in the United States, but we produce our own gas, so we haven't had to use LNG as much. But for integrated, it's very immensely profitable because they're very expensive to start up, but the returns on them are fantastic once you get these things operating over very long periods of time. Beyond that, they are looking more at the electricity generation through renewables. They have some stakes in a lot of solar companies, as well as some electric utilities. And they more or less said that, while not actively reducing the amount of oil production over the next 15, 25 years, it is going to perpetually become a smaller and smaller portion of the overall energy mix over time. So, there is a path forward beyond oil, but in my opinion, we're at least 25 years before that being a huge, game-changing problem for these companies. But it's nice to see that, having that forward-thinking idea that, hey, maybe we should start working on this now. And just one last point as to why I think it might be even more attractive today in a Total versus, like, say, ExxonMobil, Chevron. Both ExxonMobil, Chevron kind of trading at all-time highs, and both of them have dividend yields right around 3.2% versus Total, which has they have a dividend yield right now of 4.6%. So you're getting a significantly higher yield, and a lot of the industry dynamics that have benefited the aforementioned Exxon and Chevron, Total is benefiting as well.